Commtrendz is India's premier research agency for multiple asset classes, including commodities and forex. Commtrendz works with corporations both in India and overseas, and of course, any organizations who are exposed to commodity and forex price risk. Today, we bring to you the non-agri commodities market outlook for 2026. In this episode, we propose to cover the macroeconomic background in the crude oil market, the bullion market, and major base metals. And after a few days or so, we propose to bring the 2026 outlook for major agri commodities like vegetable oils and cotton. Now, before we proceed, just let me mention that we have, for this episode, two of India's foremost experts in the commodity space. First, Mr. G. Chandrasekhar, former commodities editor at the Hindu Business Line and former economic advisor to the IMC Chamber. He is currently an independent member of the SEBI Commodity Derivatives Advisory Committee and board member on several corporates. His views continue to shape both policy and industry sentiment and highly sought after by policymakers and think tanks of the government. Sir, it's an honor to have you back with us. Thank you so much for your time.
Thank you.
And with him, Mr. Gnanasekar Thiagarajan, head of Commtrendz Research, who began his journey at Wall Street Journal, working alongside technical analysis pioneers. Later, he traded at Scotia Bank, the Canadian bank, which is also the largest bullion bank in the world. He helped build market participation in its formative years and remains a leading voice across media on commodities and forex. I'm grateful to have both of you continue this series. Our listeners are learning so much because of the knowledge you are sharing with us. So, for today's episode, we intend to bring the 2026 market outlook based on fundamental analysis and technical analysis so that we can give you a holistic picture of what is likely to happen over the next few quarters. Now, before we dive into specifics, I just want to set the stage. 2025 has been a year of rate cuts, geopolitical reshuffling, Donald Trump returning to the global economic narrative, and commodities trading like macro assets rather than raw materials. So today, we'll break down gold, silver, crude oil, and major base metals to understand what structurally shifted in 2025 and what it means for 2026. We will now hear from Chandrasekhar sir. Sir, what is the macroeconomic backdrop for 2026?
Thank you, Kaushik, for this very warm introduction. I'm delighted to be a part
Thank you,
of this
sir.
conference show. This is wonderful. I think we're doing a great job. Backdrop to
Definitely.
macroeconomic outlook 2026. So far, this decade, I call this decade a disruptive decade. Okay, starting early 2020, we had the COVID-19 pandemic.
Right.
Then the whole of 21 and early 22, we had and we continue to have the Russia-Ukraine conflict, followed by Israel-Hamas war, etc. And that's how 20, 21, 22, 23, all of that went by. And in 25, as if all this was not enough, came one Mr. Donald Trump to the White House. And the US-led trade tariffs have caused enormous geoeconomic uncertainty and geopolitical instability. There is absolutely no doubt at all. And all this has led actually to inflation. And this has also resulted in a series of, I would call, very unusual and disruptive activities. What are those? Sanctions on Russia, for example. you have protectionism, countries wanting to protect their natural resource.
Right.
Resource nationalism, which is again very important. People are kind of
Hmm.
nationalizing their resources and feeling very nationalistic about their resources, and therefore curbing export of sensitive commodity. Obviously, we had supply chain disruption without any doubt, both in the Black Sea region and, of
Yes.
course, in and around the Middle East region, etc. All that we understand. All this resulted also in enormous price volatility in commodities, market uncertainty, and for me, more important, there was investment uncertainty. Investment in real assets. Corporates were not very sure how long this disruption is going to continue, and therefore, in 24 and in 25, there was a perceptible decline in investment outlook, and
Right.
therefore that may actually take a toll at a future point of time. Therefore, very clearly and simply put, we all now live in what I describe as a VUCA world. And VUCA world, VUCA, is actually characterized by volatility, uncertainty, complexity, and of course, ambiguity. This is
Right.
the backdrop. But I want to talk about what are the key themes. There are some key themes for 2026 which I would like to share. Let me start with a fairly positive statement. In my own view, looking at the global economy and the recent developments, the macro outlook for 2026, in my view, global macro outlook looks optimistic, looks positive, or there is a cautious optimism about global macroeconomic outlook is number one. Second, global trade risks and geopolitical risks, in my view, appear to be easing. What they were
Hmm.
exactly a year ago, early 2025, they seem to be substantially easing now, or let me put it this way, less threatening. They were really threatening in say, March, April, May, June of 2025. They are far less threatening at this point of time. Again, my own sense, the US tariff risks are expected to abate further. They're already abated, and of course,
Hmm.
it'll abate further. All this can also result in actually, it raises the possibility of a new global order in the wake of tariff and trade deals with the US is signing and other countries are signing. One known unknown is, in my view, artificial intelligence, AI. Now, AI is exerting pervasive influence across the lives of mankind like never
Right.
before. And many of us actually don't seem to realize the kind of influence that it is already exerting or it's likely to exert in future. So the big question is, uh, will AI become the shock absorber for the world? The world has gone through the
Right.
disruptive decade that we talked about. Will it be a shock absorber, or will AI turn out to be a shock magnifier? We don't know. At least I don't have an answer. We actually don't know. It's a very tricky question, but let us hope for the best. But when I look at the balance sheets of those companies called corporations called hyperscalers, the hyperscalers have presented very positive, robust balance sheet, which means at least that until now the AI as a paradigm is not a bubble. Okay, as of now, and not a bubble yet, but we don't know how it's going to pan out in future. Therefore, that is one factor all of us must bear in mind. Fiscal policy, in my view, is most likely to remain very supportive for growth across the world. The U.S. Federal Reserve, which sets the interest rates in the U.S., in my view, has already cut interest rate three times in 2025. I'm sure it'll cut. There'll be more cuts, but will be
Right.
highly moderated in my view. and other central bankers of the world will most likely follow what the US Federal Reserve does. As a result, I expect the liquidity conditions for the economies to definitely improve and become more favorable for the markets. Important, what is called US economic exceptionalism. We saw US economic exceptionalism in 2025, and that exceptionalism, in my view, is going to is set to continue into 2026. The US will continue to be the engine of economic growth for the world, and that exceptional behavior of the US economy, I'm sure is going to continue in 2026. As a result, my view is that the US dollar is likely to post modest gains in 2026 because of US growth, while again, in my view, the carry trade will possibly take a back seat. China, on the other hand, the world's second largest economy, the Asian major, is pushing to boost its manufacturing. And I will not be surprised, especially the high-tech manufacturing. And I won't be surprised if there is more than one stimulus package that the Chinese government may announce in 2026. Very quickly, just one line, crude oil. Crude oil is a universal intermediate. The crude oil market, as all of us know, is oversupplied even now. And that's likely to continue into 2026, which will have a bearing on inflation and on economic performance, etc. Last, energy transition. Energy transition, all of us know, is metals intensive. And therefore, that metals intensity of energy transition will further come to the fore, and it will actually accelerate, and which will boost demand for metals, etc. And therefore, when you put all this, and when you look at when there is some kind of a projection of global economic performance in 2026, global growth, very broadly, most economists agree, will be around 3% in 2026. Within that, China likely to grow at about 4.5%, and the US slightly above 2%. I think that there is a kind of sense that I'm getting in terms of the growth prospects. 3%, around 3% for the global GDP growth. I think it is this backdrop that we must remember, and we must examine the drivers and dynamics of major commodities that we are talking about. This is actually the setting for the discussion that will follow.
Right, sir. So I had a small question. What do you see in terms of India's growth? Because we have been slapped by the highest amount of tariffs as far as I know. And this should certainly stall the growth that we have been seeing in the past year or so. What do you think about this?
I don't think the US tariffs are going to hurt India badly. This is number one. Number two, all said and done, we are still discussing bilateral trade agreement, BTA, with the US. The US is keen to engage with India. The US knows India is a big market. The US has its own compulsions. We have, of course, our own compulsions. And therefore, I think I won't jump to a conclusion on this. The US is an important market for India, but also remember, India actually enjoys trade surplus. We have a $45 billion trade surplus with the US. Okay, and therefore, even if there is a small dip in India's export, it's not going to hurt us substantially. But we should be cultivating other markets very, very clearly. And therefore, my view, India will chug along whatever has been the growth rate in the last 2 years or so. I'm sure it will continue, although our potential is far higher. But we should leverage our potential. But 6.5% growth, yes, will continue to be the world's fastest growing significant economy.
That's really nice to hear. Right. So, thank you very much, sir. This was very enlightening to get the entire macroeconomic backdrop for the year of 2026. So, shall we dive into specific commodities now?
Absolutely.
I
Why
am
not?
thinking let's start with gold and silver.
Yes.
So, gold and silver actually has attracted tremendous attention in 2025 with its stellar run. And what's in store for us for 2026? What do you think, Chandrasekhar sir?
Uh, the whole world is discussing gold and silver. And I'm sure, of course,
Right.
hopefully, we'll bring new insights into this discussion, is what I believe. As far as gold is concerned, of course, all of us know it's had a fantastic rally in the whole of
Yep.
2025, 60% plus rally. And my view, this rally is actually a reflection of structural, fundamental, seasonal, and sentiment-driven demand. It actually it reflects multiple things: structural demand growth, fundamental
Hmm.
approaches, seasonal, and of course sentiment-driven demand. Everybody is buying gold, therefore I should also buy gold. There's something called the
Yep.
bandwagon effect. Okay, but anyway, be that as it may, for 2026, I see a fairly constructive outlook for gold. Okay, but in my view, it won't be that kind of an extraordinary comet-like rise that gold enjoyed in 2025. That kind of a rise will may not happen in 2026. Primarily because there is a mix of a kind of structural shifts, macro factors, etc., etc. And therefore, the Fed is still in the easing cycle, and therefore it makes the outlook for gold positive. I
Right.
think we also need to keep an eye on who's going to be the next Fed chair and what is his attitude.
Hmm.
Will he be? Will he be dovish? That is what is that is what is very important. And if he is, then of course it'll increase the attractiveness of gold. But on structural shifts, I believe gold is, of course, all of us know, is a very good portfolio diversifier and hedge against geopolitical stresses, policy uncertainty, stagflation risk, etc. And
Yes.
that role for gold has not changed in
Hmm.
2025. Very clearly, it came to the fore, and more likely in 2026, that role will continue to remain unchanged, which is important. But
I
what
see.
has evolved, is the degree of portfolio allocation to gold. Okay, uh, in my view, it is likely to be structurally higher, okay, than in the past circles, and which is what we found in 25, and that can potentially continue into 2026. And the participation has also been very broadly broadened beyond the dominant anchors of demand from official buyers and institutional buyers. There's a huge
Hmm.
amount of retail that's actually happening. Retail participation is up very significantly, and that reflects the accessibility of this metal, gold, precious metal, through, for example, digital platforms, etc. And of course, growing awareness about gold's resilience and store of value. So increased awareness amongst people. And if I may mention, in the last 25 years, gold has, on an average, risen by about 12% vis-a-vis the US dollar per annum, 12% per annum vis-a-vis the US dollar. But gold's rise of about 34% in 2024, and
Hmm.
twice that, or even more than twice that, in 2025, has actually caught, in my view, the attention from even a wider audience. People who never invested in gold derivatives or whatever, digital gold, ETF, it caught the attention of a lot of people because of that phenomenal increase in prices. Therefore, there's a cause and effect. Prices started to rise, and therefore it attracted attention. More people joined, more people invested, and therefore prices are going up again. And for that, the kind of a very positive cycle, virtuous cycle that gold has entered, and then I must also mention that we need to be cautious, but at the same time, let me also mention the BIS, Bank of International Settlement, has also said that there's a huge amount of speculative capital which has come into the gold market. It was as far back as June 2025, and that noted that 95%, they did a survey, and 95% of the respondents believe that the official gold reserves will continue to increase up from 81% last year when they were asked about the expectation of central bank purchases, etc. So it's constructive. The mood is very positive. Large number of participants, very large volumes, huge amount of speculative capital, institutional investors. Having said this, I am actually a contrarian. I usually take a contrarian view because I want to caution. I want to caution people. I want to talk about risk factors over the next two or 3 minutes. One, is there anything that can bring about a shakeout of long gold? Gold sentiment is now long. So you buy today, prices will rise, and you sell at a future date. But is there anything that can impact gold's sentiment? One, if there is a sharp repricing in the yields higher due to sudden stop in rate cut cycle. I told you we talked about Fed share, his attitude, etc.
Yes.
If there is a pause in rate cut cycle, that can potentially affect gold prices. But we don't know how it's going to happen. But this is one possibility, and we need to build a scenario. Second, what if central banks stop buying gold? I remember in 2024, central banks bought 1,100 tons of gold, led by China, People's Bank of China. But look at 25. It is just about 900 tons, 920 tons or something. A 20% decline in central bank buying in 2025. Will 2026 be different? Will there be a further fall in central bank purchases? We don't know, but that's a risk investors have to bear in mind. We all know the People's Bank of China has actually curtailed gold purchases because of high prices. Makes no sense for me to buy at $4,000 plus at these levels per ounce. So I don't think anybody would buy for reserve purposes at these high prices. Physical demand, very clearly physical demand is weak. All of us know import numbers and jewelry sale numbers are all very clear, both in China and India, and even in other price-sensitive markets. And at the same time, geopolitical risks can actually play a two-way game. If geopolitical risks abate, if there is a compromise in Russia-Ukraine war, and of course the other Israel-Hamas is very substantially under control, that can when the geopolitical risks reduce, that can remove the current risk premium that is built into the prices, and it'll weigh on the price of gold. On the other hand, if the geopolitical situation were to worsen, we don't know that anything can happen. Then, of course, gold will have another huge spike, and that is why the BIS, Bank of International Settlement, has warned that gold has become a very risky asset. It has become as risky as the equities. And as you rightly mentioned, Kaushik, in the opening statement, that it has become a macro Macro asset. Very well observed. And
Yeah,
therefore, in addition to institutional investors, even retail investors have jumped into this bandwagon, which do speculative investment. That
correct, sir.
that whenever a market, the commodity price goes
Mm,
extraordinarily high, then there is the chances of a sharp correction also increase proportionately. And therefore, I would think investors have to exercise caution. Make hay while
mm.
the sun shines. There is no doubt at all. But be
Yes.
careful. The market is not going. It's not a one-way street. Market is not going to keep rising all the time, and therefore watch for signals. You will get advanced signals when the market is ready for a correction, and then
Mm,
you must exit your position. That's what as gold is concerned.
right. And how do
Good.
you see silver shaping up for 2026?
Absolutely amazing. Again, extraordinary. I think I want to use that expression, comet-like rise in silver
Absolutely.
prices, and the again convergence of structural tightness, momentum buying, and of course a very conducive macroeconomic environment that we talked about has created this surge in silver prices. Silver for the fifth year in a row in 2025 was in a state of deficit, a serious
Mm,
deficit. And we all know it is not just a precious metal, it is also an industrial metal. And
yeah.
with energy transition picking up in an accelerated way, its demand in the energy transition space, whether it is solar or EVs, electric vehicles, or electronics, charging infrastructure, all of that, there's a real consumption. Unlike gold, silver consumption is a real consumption. I'm sure you understand the significance of real consumption. Silver is
Absolutely, sir.
actually used, physically used in and consumed in
Yes.
these industrial sectors. And therefore, to that extent, the demand for silver has actually gone up. And as I said earlier, market has been in a state of deficit. It's likely to continue to be in a state of deficit. And also, because gold and silver move in tandem, there is
Mm,
also, sorry, on silver, a spillover effect from gold, which we have seen for last so many decades. Silver also draws its strength from gold, and therefore silver has that gold is exerting its spillover effect on silver. And so I'm thinking again there is reason to be bullish on silver without any doubt at all, both as a precious metal and an industrial metal. But
mm.
silver prices will surely remain elevated in 2026. But I would advocate extreme caution because of price volatility. Well,
Yeah.
investors have to be cautious. As I again said earlier, make hay while the sun shines, but be conscious, be cautious, and exit the positions the moment you start getting signals of of a correction. I'm not giving any price outlook or price target, etc. But the direction, directionally, of course, both
Yeah.
gold and silver would go up in 2026, is my view. But with huge amount of volatility. That is what is going to, that's why investors have to exercise absolute caution. Thank you. Yeah.
Understood. And so just one more small question regarding silver. How do you see AI factoring into the prices since semiconductors generally use silver to uh, as a substitute for gold, let's say?
AI, data centers, for example, cryptos,
Yeah,
etc. They're all
yeah, exactly.
highly energy intensive, and therefore that is where silver also comes into play. Therefore, there will be an increase quite apart from your solar panels, electric vehicles, charging
Yes.
infrastructure, electronics, etc. I think there is a new demand segment which has come up, and your AI is what I call power hungry. Okay, the word
Definitely.
power hungry.
Metaphorically and literally.
Yeah, metaphorically, power hungry or electricity hungry,
Yeah, yeah.
and therefore I think it will certainly have a role. It will add to gold's glitter in market.
Understood, sir. So thank you very much, sir. That was very eye-opening. And now Gnanasekar, how do you see it from a technical perspective? So what are the charts telling you about gold and silver's future in 2026?
Yeah, I think firstly we need to understand what is the biggest fundamental change that has taken place in the bullion complex.
Right.
Uh, it's this is the analogy which I generally tend to use, which is the dog wagging the tail. So it's the other way actually. The derivatives market is supposed to take direction from the spot market. That's been the case all the while. But that changed quite a bit once there is this excess liquidity that came into the market by way of funds, dominating the commodity play. But this year, that's the big change that we have noticed. Now, again, it's back to the cash markets. You can see the disconnect between the cash markets in both gold and silver right now. So that clearly says that the order is changing in the entire bullion ecosystem. So the speculators who used to wield their influence through the kind of money at their disposal is not able to, because suddenly they see the cash markets extremely active, hardly any precious metal available, especially in terms of silver. And that is seen continuing in 2026 as well. So this cash markets being in a deficit and the derivatives unable to rein in over the cash markets is something which will continue in 2026 and probably even the years ahead, I think, because it's a fundamental shift that's happening. Uh,
I see.
the other important thing we need to keep in mind is the other assets like equities. Though I'm not an equities expert, I can very clearly see this commodity super cycle that is in play uh, is increasing raw material costs like anything. So
Hmm.
that will clearly have an effect on the P&L. Demand for their products will go down because consumption will come down at these high prices. So companies are not going to make the kind of profits that they used to make earlier. So these are the two important themes that I will go into 2026 based on what I've seen so far. So, coming back to your question on gold and silver, from a pure technical perspective, sir
Yes.
has elaborated everything. So, I really don't need to cover anything on what is driving it right now. Uh, but the drivers that are presently driving precious metals will continue to do that in 2026. But like he rightly said, there is a good chance that the dollar might make a comeback because this year the dollar has taken a huge beating because of the tariff, the trade flows. But many
Yeah.
countries have now made peace with it, and so is India in the process of.
Hmm.
Then it will be business as usual, but at a higher cost.
Yeah.
So that would boost the dollar to some extent, and the risk appetite for the dollar would pick up, and that will be a dampener for precious metals. Because once the dollar strengthens, the possibility of rate cuts starts going down. That's when it will start hitting the precious metal complex. It could happen potentially in the second quarter of 2026, or in the third quarter. But then this is a clear warning sign that sir has highlighted, which I see potentially spanning on because we cannot take this rally for granted. It's not like a stock market rally which will keep going one way without any meaningful correction. This commodity markets, especially bullion, is very highly susceptible to corrections. It has not so far simply because of the disconnect between the cash market and the futures market. That is what
Right.
we. Once that balance comes back, then we will see some sizable corrections happening. So I'm going to see if I can add some quick slides just to show you a few things that I have in mind on the technical picture.
Sure.
What kind of worries me the most is basically the gold silver ratio. That's gone completely out of whack.
Yeah.
So if I sort of see the way in which it's kind of taking shape. Sorry, I'm unable to show it correctly. Just give me 1 second, please. Yeah. So I'm able to see, Kaushik?
Yes.
Yeah. So this is the gold silver ratio. You can see it was 126 in 2020, which means for 1 ounce of gold, you put 126 ounces of silver. But look at it right now. You can only buy 57 ounces of silver for 1 ounce of gold. So that's like a deep correction that has happened, and it's aligned itself. So far, silver had to catch up with gold's rally. It has done that. But this
Correct.
is really worrisome because the way people are piling on to silver, like there's no tomorrow. This worries me a lot because silver here is becoming overpriced compared to gold. And even if I look at gold per se, it has a limited upside. And I think that to me is somewhere close to 4,750 to 4,800. That's the technical targets that I'm working with. I'm not going to be more bullish beyond that level. And so silver, I think, is overdone. Having come here, it could stretch to 80, 85 cents also. This is again from a pure technical perspective, not a price outlook kind of perspective. Just what I see as a chartist, and what the charts are indicating. A very sizable correction is in the offing, most likely in the range of $60 or so in silver. So that is how the technical picture looks to me. So though it's all rosy at this point in time, you have to approach it with extreme caution, and it's not going to have the similar moves that we saw in 2025. It's going to be very measured and could be completely on the opposite direction also. That precaution.
Yeah. So I actually had a small question for you. In the last year, we have seen speculative funds and managed money switching from commodities to equities really quickly. And correct me if I'm wrong, I have never seen something like this before. Do you see this continuing in the year of 2026? And also, could you inform us why this is happening?
That's for me, Kaushik?
Yes, for you, Gnanasekar.
Yeah. See, the primary reason, according to me, and this sir would be in a better position to elaborate on that.
Right.
I think the primary reason for that is the way trade uncertainties have shaped up, and that has forced many to look at bullion as a safe haven and as a hedge against uncertainty, both economic as well as geopolitical. That's one of the reasons why a historic amount of money has come into safe haven, because there's a very clear threat because of this trade policies that the traditional assets like equities won't do well. That is why we've seen this kind of an explosive movement that we've seen. But keep in mind that it's a zero yielding asset. It only has an appeal when there is a potential for it to rise. Sir rightly pointed out the central bank buying has come down quite a bit. And so will be the retail demand, because once retail is now seeing this, price going up, and they're very enthusiastic about it. But once it reaches a saturation point, and once it sort of, you know, fails to sustain at higher levels, then they'll all get cold feet, and then things are going to change drastically. But I have seen, at least in the last 20 years, there are many instances where the very same investors used to go and sell gold and silver at higher prices. Then they thought it was high when it was 25,000 per 10 grams.
Right.
And so, that hasn't come yet, but it might come in the coming year. These are all possibilities that we have to work with. We can't ignore them. But Sir actually can elaborate on this better. Sir,
Yeah, so could we have a little bit of your wisdom on this matter as well?
Yeah. There are multiple factors that drive the equities market and multiple factors that drive the commodities market, but more specifically, the bullion market or the precious metals market. But there is usually a negative correlation between equities and gold in terms of pricing. But there have been occasions in the past, say 20, 25 years, when both have gone up, both have increased, and both have collapsed also simultaneously.
Yeah.
So there is a certain correlation. But what we found this time was the bullish factors for equities and bullish factors for the precious metals both are working simultaneously, right? And therefore, that negative correlation broke, and both had positive tailwinds and positive support factors that worked together. But generally speaking, investors are more comfortable investing in equities in what is called a risk-on environment. Okay.
Right.
And 2025, I won't say was a risk-on environment. Not really, not really. And therefore, there is a fund flow towards safe haven assets like gold, etc. But will 2026 be different? Will there be a risk-on environment in 2026? I believe yes. Interest rates are likely to decline. Inflation will come under control. If Mr. Donald Trump or the U.S. administration strikes more deals and the tariff impact starts to taper down, and if geopolitical tensions abate, I think there will be a huge further spike in the equities market, which can potentially then impact the commodities market. But because prices started to rise, there's a huge momentum of new people that have come into gold and silver investment, huge amount of retail investment, that they jumped into this bandwagon, hoping that they will make hay while the sun shines. Therefore, prices have actually gone up. But once your support system starts to weaken for gold and silver, which to my mind appears likely, as on current reckoning, sometime in 2026, whether it is geopolitics or the US dollar, etc., inflation, all of that, then I think there could potentially be a very, very sharp correction, because I suspect these levels of 4,000 and above are unsustainable. Unsustainable in the long run. They will have to correct. But silver slightly different. Silver has also had an extraordinary bull run, but there may not be a crash in silver, primarily because of a demand for real consumption that we talked. There will be a correction because the spillover effect from gold will impact silver, but the kind of fall that gold can potentially suffer, silver will suffer much less severe fall in my view, because of the demand for real consumption. And therefore, we need to wait, watch. We don't know how things are going to pan out. And therefore, investors have to exercise caution and look at your charts and other macroeconomic indicators, what they are telling us. That's important. You have to be glued to the market. Yeah.
Definitely. Thank you so much, sir. This was very enlightening for me, and I'm sure for our listeners as well. So, shall we move on to crude oil now?
Yes.
Crude oil is actually a very critical commodity for the world because it fuels economic growth. And now we all know energy prices have come under pressure in the recent months, and there is possibly both supply and demand side factors that are playing out. So, both economic growth and geopolitics play a big factor in crude oil's growth. And what do you think about this, Chandrasekhar sir? How do we see crude prices shaping up in 2026 now?
Before we go into crude oil, I must mention, and I should have given the disclaimer even at the beginning, but treat it as
Right.
a disclaimer I've given at the beginning. I am not a trader. I don't hold any trading position anywhere, neither in the physical market nor in the derivatives market. I'm a student of this market, and I'm coming from that perspective, and therefore I have no trading interest at all whatsoever. Okay. Now, crude oil, extremely interesting. Universal intermediate, as it is called. So fundamentally, in 2025, global oil production actually increased by about 2.5%, 2.6% year on year. And it reached an average of about 105 million barrels a day. That's the kind of the number. And this growth in production, 2.6% year on year growth, was driven by both OPEC plus and of course the non-OPEC oil output. There is no doubt at all. And
Yeah.
the growth in OPEC plus production obviously reflects the unwinding of voluntary production cuts. They all had agreed in April 2025. Therefore, that's unwinding, and therefore that it reflects an increase in production. My view, supply growth will accelerate in 2026 because I would think, and I'm convinced, and all of us should be convinced, that new production will continue to be phased into the market, into the global market. It will all come into the market. They will not curtail production. They'll continue to produce and bring it to the market, and therefore supply growth will accelerate in 2026 much more than in 2025 is one.
Right.
Second, on the demand front, I think global oil demand, in my view, is likely to remain broadly stable. It was broadly stable in 2025 at about 104 million barrels a day against the production of, we talked about 105 million barrels a day.
Yeah.
There was a stable demand at 104 million barrels a day, which in my view is likely to continue. There will be stronger consumption growth in China, which can potentially offset slightly slower growth, softer growth in the US and in India. And in fact, Chinese consumption growth has been much stronger than what people had expected early 2025, because that's that kind of stronger than expected consumption growth in China, possibly for countries, strategic stockpiling of crude reserves in the midst of oil prices. That is what is in 2025 arrested even a sharper correction in Brent prices, for example, or crude oil prices, for example. Otherwise, prices should have even fallen well below $60 a barrel that we are talking about. But China's stockpiling in its own, whatever their decision, the nation's decision actually arrested a sharper fall in prices. And therefore, if you were to look ahead into 2026, I'm expecting demand growth to be very broadly stable, like in the previous year, and there is a strong positive correlation between global economic growth on the one hand and energy consumption on the other. Positive correlation, and therefore, because the institutions like IMF are all talking about global growth of 3%, 3.1%, etc., I think that there will be stability in consumption. Therefore, in 2026, we can expect very well supplied oil market that will meet demand in 2026. And because the market is going to be well supplied, possibly slightly oversupplied, it will exert a downward pressure on oil prices. Second, easing geopolitical risks will reduce the risk premium. In oil prices also, like in gold, there is a risk premium. And that risk premium will reduce once geopolitical risks start abating. And again, that will contribute to a more stable price environment. And when all this were to happen, slight oversupply, reduction of risk premium, geopolitical risk premium, etc., that portion of speculative capital or investors who have invested in crude oil, they'll quickly exit. And once that speculative capital exits a crude oil market, there'll be a disproportionate impact on prices. There could even be a sharper correction in prices, because often speculative capital exerts a disproportionately larger impact on prices, both on to the upside and on the downside, which is like gold, for example. Disproportionate increase in prices. And silver, in fact, more important, disproportionate increase in prices, not related to fundamentals. Therefore, all that can also potentially impact your crude oil prices. But my own sense, looking at the OPEC production, geopolitics, how it's panning out, etc., if I were to take a view of the first half of 2026, I would think the oil Brent has a potential to fall further from the current levels, and I won't be surprised if it were to trade just within the vicinity of $60 a barrel, plus minus $2. Right. Market will be volatile, plus minus $2. But I'm saying with a downward bias, $60 a barrel plus minus $2, but with a downward bias. So therefore, this is good for the global economy. This is good for India. We are very large importers. Obviously, of course, we are also, energy transition is again going to have some amount of impact on the crude oil market as we go along. So I think, and therefore, a lower crude oil price also means lower inflation. Energy inflation will be lower. So all these are positive. So I think I'm looking at a fairly not exactly a bearish, but softer prices and consumer friendly prices. This is what is likely to happen to your energy market or the crude oil.
Understood, sir. So I actually wanted to ask you about the growing energy transition for EVs and solars and how that will factor into the crude prices, but you've already covered that pretty much, sir. So thank you for talking about that as well. And now on to Gnanasekar. What are the charts speaking to you about crude oil markets? Now we can see that crude has entered a small downtrending phase over the past few months. And do you think that will continue in 2026, or do we see a sort of bounce back up to the 60 to 65 levels? What do you think, Gnanasekar?
Yeah, a good question, because, and again, I'm taking you back to the charts here. Sir has again given a very clear idea of the supply-demand situation. And if I have to go with the theme, I think it's supply that's going to outpace demand going forward as well. And if the Russia-Ukraine peace deal kind of goes through, or even the current situation cools down, clearly, we will have more supplies, and the Russian supplies will become official. And that would sort of create more pressure on prices. And add to that, we have the alternative energy space that's anyway growing. So fossil fuel demand is going to be under pressure. So with that, you can very clearly see we are testing some critical supports near 56, 55
Yeah.
in WTI. With this, weak picture that we are seeing right now, it's a very good possibility we can come close to $35 in 2026. But
Right.
this is a pure technical target. It's not that it will be achieved. It might come close to that. It might, once it goes below $50 itself, I think all these OPEC countries will start making noise, and they will again possibly resort to cutting production. That could boost prices again. So some volatility will be there. But its trajectory is, it's towards $40 or thereabouts. So I'm being a little conservative saying 40, but I'm having technical targets somewhere near $35 or so in WTI. So which means Brent could be another $5, $40, $45 thereabouts for Brent. Like Sir pointed out, I think that's a very positive thing for the Indian economy because our imports are largely based on Brent, and that will bring down the deficits in a big way, and that will be very helpful for the Indian economy, for the growth engine to accelerate.
Absolutely. Yeah.
So just to put the price thing in perspective, the charts are looking bearish, but a word of caution, crude can really have some very sizable moves, unlike what we're seeing in gold and silver today. We'll not be able to see that in crude because it's an extremely well participated market. It's in terms of liquidity. So you won't see, because this illiquid situation, what we're seeing in silver is what is driving price. So that kind of illiquidity will not be there in crude. So a geopolitical event is the only possibility where it can really turn up sharply higher. With this US economy gradually looking up in the coming year, the demand could look up from there as well. But the biggest threat is Russia opening up their oil supplies, which was unofficial so far, which could potentially become official, and that could pressure prices. So this is the numbers that we're working with. Back to your question.
Yeah. So just had another small follow-up question for you. Do you think the price has not reached the bottom yet? Well, according to you, you're saying it could go down to 35, but of course, we could see some corrections as well, can't we?
Yeah, like I said, technically it's looking like that. See, what is the technical appearance and what the market actually does can be a little different down the road. Depends on various factors that can come in from time to time. But the bias at this point in time is bearish, weak, as far as the chart picture is concerned. So it could be 35, it could be 40, it could be 45, but potentially a $10-15 downside from here is possible.
I see.
And what is the time frame, Yana, for this forecast?
It could be within the second quarter of 2026 itself.
Oh, okay.
Right.
It's amazing. I mean, that is actually in some way scary. It is scary.
Yes.
But that kind of precipitous fall that you're seeing, yeah, it may not happen, but the charts are saying that. So I understand what you're saying. Yeah, I appreciate that. Go ahead.
So Chandrasekhar sir, I had a small question for you as well. So at these low prices, how would price-sensitive markets react, and how would that affect procurement of crude in general?
No, obviously, price-sensitive markets, import-dependent markets will all be happy to import and consume more. There is no doubt at all. A country like India, for example, even China, for that matter, will continue to import. And once the sanctions on Russia are lifted, for example, sanctions on Iran are lifted, there will be a flood of oil in the market, and therefore I think that should actually help India. It can even help strengthen your rupee in some way, because lower oil prices will probably contribute to lower trade deficit.
Right.
And therefore, all that will pan out to be very, very positive. But it will also increase consumption of crude oil. But I'm only hoping that the benefit of the lower crude oil prices is passed on to all the consumers, which has not happened in recent years, unfortunately. But anyway.
Yes, exactly. Okay, sir. So thank you very much. This was very enlightening to understand the bigger picture in crude. And I guess we can now move on to the base metal complex. So in base metals, surely there are two key base metals, copper and aluminium. We also have zinc and nickel and lead and tin. So for this section, I want to ask Chandrasekhar sir to share the base metals outlook for 2026. Sir, how do you see the metals market shaping up in 2026?
Yeah. But very quickly, let me capture what happened in 2025 to better appreciate what is likely to happen
Definitely.
in 2026. One, metals market have posted fairly strong gains in 2025. The LME metals index is up more than 20% since the start of 2025. By the end of 2025, over the year, it's actually up by 20% plus. And it has reached its highest level, that index, since March 2022. That's only shortly after the Russia-Ukraine war broke out. And therefore, but the contribution of each base metal is different in this drive up of the LME metals index, but it was primarily driven up by copper and aluminium that drove the index up. But therefore, overall, if I may say, make a statement, the most metals are likely to be well supported in 2026 for multiple reasons. One, of course, we talked about improved growth prospects. Second, potentially falling interest rates. And in some cases, the tightening fundamentals. All these are likely to support base metal prices in general, but there are finer variations between metals and among metals, which we will go into. Now, China is curbing overcapacity in steel, and that is likely to actually affect the related base metals like nickel and zinc. And it's even setting, China has set a new, new limit on metals production. About 10 non-ferrous metals have been identified whose production must decline by 1.5% per annum over the next few years, starting with 2025, and therefore that will happen in 2026. For all that, therefore, on the demand side, there's a fairly stable and slightly growing demand, but on the supply side, there are going to be challenges. Now, if we go to copper very specifically, obviously in 2025, copper has seen a phenomenal price reaching a record of about high of about $12,000 a ton very recently, which is 1/3 higher than at the beginning of the year. And therefore, the main driver for copper has been the concern that supply will not be able to keep pace with rising demand. That's the concern which has driven copper prices up. We have a long-term, very positive, optimistic demand outlook for copper, and we have talked about it in the last 2 or 3 years, and I've written commentaries on that. And this optimistic outlook, long-term outlook, is boosted by advances in obviously electric mobility, e-vehicles, and expansion of data centers. It's which is very important because, as we said, power-hungry, electricity intensive data centers, and with increased use of artificial intelligence. Well, at the same time, copper production is threatening to fall behind. Okay, it is important. But I also believe, and it's quite natural, that if production is threatening to fall behind, if there is a sharp rise in demand, and suppliers are not able to catch up with the demand, and if that situation continues for some time, which is what has happened in 2025, there will be at some stage supply response to high prices. High prices will actually drive supplies higher, which is normal economic phenomenon. There will be supply response to prices. Even now, I am finding that higher copper prices are driving investments in both brownfield and greenfield projects. 2 years ago, I remember we probably discussed, commented on copper prices potentially reaching $15,000 a ton by 2030. Okay, but now given the current situation, I won't be surprised if that happens even 2 or 3 years earlier. Okay, which
Right.
could be 2027, $15,000
It's looking very likely.
Yeah, looks likely. Aluminium is a very, very, very interesting story. And obviously, aluminium market is focused very substantially on China. And China is approaching its full production cap, its capacity and the limit. And China, along with several other producers in different parts of the world, are considering closure of aluminium production because of very high power prices. No, power prices are fine. Aluminium is a highly power-intensive manufacturing process, and therefore many corporates are thinking of even closing down production. And most likely, aluminium market, global market, will stay in a state of deficit in 2026, possibly to the extent of some 200,000 tons. Okay, that's the kind of deficit. Indonesia's output is rising, but it's the pace of increase of aluminium production in Indonesia, in my view, is not likely to offset the near-term tightness. Therefore, near-term tightness will continue. As someone who's been looking at aluminium prices, I would think that on an average in 2026, aluminium should hover around $2,900 a ton. But there could be an upside risk to the outlook, which will be, of course, obviously, if global industrial activity picks up, demand will pick up, and therefore there will be an upside risk to prices. But there could be downside risk to prices, which will be, of course, faster than expected Indonesian supply growth, if that were to happen. And whether China's cap on its capacity, will that hold, or will China loosen that cap or the ceiling on its capacity? All there are multiple things that can potentially happen. But we also know very clearly, okay, aluminium is increasingly replacing copper in many of the applications, including in the mobility industry, automobile industry, for lightweighting, because copper is heavy and expensive. There is a gradual induction of aluminium, which is much cheaper and much it's lighter in weight. Therefore, the lightweighting of vehicles. For all of that, I think aluminium is kind of making a comeback. On nickel and zinc, very quickly, 1 or 2 lines. I'm thinking nickel. I don't expect any big change in the midst of persistent surpluses. Nickel market has been in a state of surplus. I expect nickel prices to remain under pressure. In case of zinc, even that upside potential or upside possibility for zinc, in my view, seems very, very limited on current reckoning. And therefore, zinc and nickel, by and large, fairly stable prices. Lead market, very clear surplus. I was speaking in a lead conference earlier in December, and lead market is very clearly in a surplus for 2 years in a row, and this surplus can continue into 26, 27, and maybe 2028, and therefore I would expect lead market, lead prices to continue to remain range bound, possibly at about $2,000 a ton, plus minus 5%. Okay, so $1,900 to $2,100. That's the range in which lead market would behave. Lead is a wonderful commodity. wonderful metal, that's fantastic recyclability. And therefore, I think we will continue to use lead, reuse, and reuse, use old batteries, ferret out lead out of all that, it will go for recycling itself. Therefore, this market is very well supplied, and one can expect fairly stable prices. I think I'm done with base metals.
Understood, sir. Thank you very much for sharing us your perspective on what could happen in 2026 in terms of base metals. So now we'll move on to Gnanasekar. How do you interpret this trend in base metals technically and through the charts?
Again, looking at the most important metal, copper, in that complex, there's a lot being talked about copper as an ex-silver and all that. I somehow am not in that camp because base metals, specifically copper, it has the kind of fundamentals which silver doesn't, and it can react to actual fundamentals, unlike silver. So there's clearly no comparison between the two. And linking the bull run we saw in silver to copper is just a fascination going forward. Because, like Sir pointed out, the supply response could be quick at some point in time. And we work with corporates, and we know how fussy they are with raw material prices, because the end product they put depends on the raw material price. And clearly, that would upset the projections they have internally. So that's going to happen across the board in different companies. And consumption in metals is likely to go down with some enthusiasm initially in the first quarter. But all the factors that Sir pointed out is certainly going to keep copper strong. And you can see here, we're working with projections of somewhere close to 13,675 or thereabouts eventually, which could take a year's time or so. But 12,500 itself will be some kind of a very strong resistance to move forward. It will be met with a good amount of producers selling those levels. And so the picture is optimistic going forward, but again, cautious optimism. If any change in the Federal Reserve positioning could affect metals as well. So these are all things that we need to keep in mind. Again, if I look at the other metals, they look a little different compared to copper, because they have to do some catch up when you compare it with copper. For example, aluminium, I think, has some upside. It has, like Sir pointed out, it's replacing copper in many areas, so that could take it all the way up to $3,200 on the upside. And zinc, he rightly pointed out, it still doesn't have that kind of strength. So it is looking a bit weak. So in the entire complex, I see zinc not doing that great. Wherever it has reached so far itself is a bonus. There is going to be some problems there in sustaining the current price levels. So just to put the charts back in perspective, copper looking quite good from here, but again, strong resistance is ahead, and aluminum looking extremely good. Zinc not looking that great. So with that, I'll hand it back to you, Kaushik.
Well, actually, I had another question for you, Gnanasekar. So in copper this year, we saw 3 separate mine disruptions that halted supplies, and also USA adding it to the critical mineral lists along with putting tariffs on refined copper. So do you think these strong bullish factors could help break the resistance sooner rather than later into 12,500? What are your thoughts on this?
Yeah, I think most of these factors that you're talking about is priced in already. So these resistances are critical to watch. Like I said, it's not like a investment related metal where a lot of speculative capital just comes in just like that. You have a very clear industry which is running based on copper as a raw material. So it cannot just exceed certain levels like what we're seeing in silver. So it'll be tough to cross these resistances in my sense. But these factors they're talking about are genuine. It will keep driving the price. We call it buy on dips kind of an opportunity. So any
Understood.
dips will be well supported. But at the same time, we need to be very cautious about these resistances that are pointed out.
Right. Yes, Chandrasekhar sir.
If you're talking about U.S. tariffs on copper imports into the U.S.,
Yes.
it's like this. That's not going to that's going to obviously reduce to some extent imports into the U.S. Okay?
Hmm.
And therefore prices in the U.S. will remain high. But reduction of copper import into the U.S. will create so much surplus outside of the U.S. ex-U.S.
Right.
Okay? Number one, that will have an impact. So there will be a price differential between the U.S. markets and non-U.S. markets. That is what is
Understood.
going to happen. Tariffs are not going to disrupt entirely the copper market fundamentals, which is important. Number two, in the US, there are 2 or 3 copper mines and copper production facilities, which had in some way they had stopped production. But I understand that they are now being encouraged to enter production. How soon
Right.
they will be able to do, we don't know. And therefore, it's not going to disturb or dislocate the global demand supply fundamentals. And for all that, I won't be surprised if in 2026, Mr. Donald Trump softens his stand on tariffs, and he will have tariffs,
Yeah.
but not at those fancy levels that he's been talking about. That will also have a certain impact. Yeah.
Understood. Understood, sir. Thank you so much for sharing your knowledge about this
Right,
base metals complex and
right,
helping me and
right,
our listeners understand what
right,
is going to
right,
happen in
right,
2026.
right. But Kaushik, if you
Yeah.
would permit, I want to share something for the benefit of all of us, and particularly our audience, which is important. And there's a new law which has come into the European Union.
Yeah.
It's called the European Union Carbon Border Adjustment Mechanism. Yeah.
Hmm.
The EU is very keen to reduce carbon intensity of whatever it imports into the EU. Okay, and it is across sectors. And metals obviously is one of the sectors impacted. Even in agriculture commodities, the EU
Yeah.
wants over a period of time to promote more organically grown agriculture,
Hmm.
chemical-free, sustainably grown, all of that. Anyway,
Yeah.
it's their call. They have taken that call. In case of metals, there is what is called a carbon border adjustment mechanism. I would call it CBAM. In short, it will apply. This will apply. It's actually a tax.
Hmm.
Okay, it's a restriction,
Right.
and there'll be a tax, and it apply to raw materials, semi-finished products, and emission-intensive processed products. And at the moment, it is specifically for steel and aluminum sector. Okay,
I
which
see.
is very important because the EU imports a lot of aluminum-based products, including scrap,
Hmm.
aluminum scrap. And therefore, this CBAM is supposed to start will start on 1st January 2026.
Hmm.
It will kick in, but it's not going to be immediately tariffed imports. But there is an adjustment period till January 2028. For 2 years, countries that supply these products, steel and aluminum, carbon-intensive products, will have opportunity to reduce their carbon intensity is one. Second, the EU's trading partners have already started to pressurize the European Union. And the European Union, this law, CBAM, is putting pressure on the trading partners like India, China,
Right.
and even South Africa, for that matter, to produce, say, steel, aluminium, and products in a more climate-friendly manner. Okay? And these countries, supplier countries like India, China, and South Africa have already criticized the move of the
Right.
of the European Union. How it will play out over the next 2 years, we don't know. But the European Union thinks it should put pressure on supplier countries to reduce the carbon intensity, etc., etc. That's their way of contributing to global sustainability. So what is important is in this, exports to the European Union, steel exports and aluminium export. The aluminium, whether it is a raw material, semi-finished product, finished product, scrap, all that will be covered, and therefore that can impact prices, particularly aluminium prices, if you're talking about. And within the EU, there will be because there will be a tax in this border adjustment mechanism. Prices within the EU will rise because their imports will be taxed. Correct? And therefore, and what they will do with that money, I don't know. Maybe they'll apply to reduce the carbon intensity within their own economy.
Definitely.
But it's going to put pressure on supplier countries, metal supplier countries, including India, China, etc. Therefore, this is something our viewers have to bear in mind. This is coming, and it's already becoming a law from 1st January 2026. But the actual imposition of tax will start 1st January 2028. There's a 2-year adjustment period, etc. I think this is an important piece of information. I'm honestly not very sure how many people in the metal sector are really aware of this, but it is there now. We need to take note. Thank you.
Thank you so much, sir. And very well said, because sustainability is such a growing aspect in the world in general. So it's very interesting to see how this will affect the metals market as well. Right. So, dear listeners, we have heard two expert views on some key commodities like gold, silver, crude oil, and base metals. So if you have any questions, please feel free to write to Commtrendz Research, and we are always happy to engage with you. So on that note, we'll conclude today's discussion on non-agri commodities. The landscape for 2026 is clearly shifting with geopolitics, energy transition, as mentioned by Sir, AI infrastructure, and tariffs. They're all rewriting how metals and energy behave in general. But honestly, this is only half the picture. In our next podcast, we'll turn to the real story, which begins, and it is also very important for our Indian industry as well. So we will be talking about agricultural commodities, including cotton and veg oils, in our next episodes. So how will the acreage, global supply chains, export demand, weather, and government policy shape prices in the future? And who will gain or lose in 2026? Now, that conversation is going to be one that you won't want to miss. So, for now, thank you, everybody, and we'll see you for the next episode.
Thank you very much, Kaushik, for so efficiently handling this session. I want to compliment you.
Thank you,
Keep this up. And with this, let me say good luck. God bless you all. Have a fabulous 2026.